The dollar index moves currency markets every single day. If you trade Forex and you have not spent time understanding it, you are missing a key piece of the picture. The DXY, as it is commonly called, measures the value of the US dollar against a basket of 6 major currencies. Not just one currency, 6. That gives you a broad read on whether the dollar is gaining or losing ground across the board. When the index rises, the dollar is strengthening. When it falls, the dollar is weakening. Simple concept, real consequences. The index was created by the US Federal Reserve back in 1973, after the Bretton Woods system collapsed and currencies began to float freely. It started at a base value of 100. A reading above that means the dollar is stronger than it was in 1973. Below 100 means it is weaker. The 6 currencies in the basket are not weighted equally. The euro carries roughly 57.6% of the total weight. That means EUSD movements have an outsized effect on the index. The Japanese yen comes in second, followed by the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. One thing worth knowing, China and Mexico are not in the basket, even though both are major US trading partners. So the DXY reflects dollar strength against a specific set of developed market currencies, not the full global picture. For practical trading, the DXY works well as a confirmation tool. Say your chart analysis is pointing towards selling EURUSD. If the DXY is also trending higher at the same time, that adds weight to your thinking. If your analysis says buy USD, but the DXY is surging upward, that conflict is worth paying attention to. It does not override your analysis, but it is information you should not ignore. What moves the DXY? Federal Reserve interest rate decisions carry the most weight. Higher rates tend to attract investment into the dollar, pushing the index up. US economic data, things like jobs reports, inflation figures, and GDP numbers, can also shift it quickly. And in times of global uncertainty, traders tend to move into the dollar as a safe haven, which drives the index higher. The DXY is a useful tool, but it is not a crystal ball. It tells you about dollar direction against a specific basket of currencies. If you are trading pairs outside that basket, it becomes less directly relevant. Use it as one layer of analysis, not your only one. Before your next trade on a major dollar pair, pull up the DXY on a daily or 4-hour chart. Note the trend. Check whether it supports or contradicts your idea. That one extra step can add real clarity to your decision-making. And in trading, clarity matters. As always, only trade with money you can genuinely afford to lose.